Hi class, I'm Rhonda Thrower and I will be your instructor for ACC 120. What we're going to do today is we're going to look at some terminology that's really important in accounting. So if you'll bear with me for just a second, I'm going to share my screen with you, and might take me just a second to get this pulled up. Let's see here if I can find this. All right, you should be able to see now some terms on the screen. I usually prepare notes to my classes in Excel because a lot of times I'm going to be using formulas and we're going to be doing a lot with math. And so I just went ahead and prepared my notes in Excel. And I will be posting these Excel notes to the Throwers video section in Blackboard. So when you become familiar with Blackboard, you're going to go into assignments. You're going to click on Chapter 1 assignments. And then under Chapter 1 assignments, you will see a folder that has my name on it that says Throwers Videos for Chapter 1. And I'll put this video in that folder along with, I'll also put the Excel spreadsheets for all the videos that I do within the chapter. And again, this video is just going to be about basic terminology. It's really important that you read your chapter, and it's important in accounting to learn terminology. Accounting is the language of business, and so we're going to have to learn some terms to help us to do the objectives of our class, which is to teach you how to prepare financial statements and do bookkeeping for a business. Now, one of the first terms that I always like to talk about is the term that we call assets. And assets, in its most simplest definition, the simplest one that I could come up with, were things of value that a company owns are assets. So examples of assets, I've got them listed here for you on this spreadsheet. The first example of an asset that I always like to talk about is cash. It's our number one asset. You cannot operate a business without cash. And so cash is always the first asset that I like to talk about. And cash meets the definition of an asset, which is something of value that the business owns. What we're going to be doing is we're going to be taking economic information and classifying it in this chapter. We're going to be looking at something that we call business transactions. Those are exchanges between the business and someone else. And we're going to be looking at these transactions, and we're going to be analyzing them in this chapter, and we're going to put them through what we call an accounting equation. That's the first place that we're going to be writing down economic information about business transactions for a company. And in order for you to be able to put it through the accounting equation, you have to know what an asset is. An asset is one element or one part of the accounting equation. And the definition of an asset are things of value that a business owns. I think your textbook calls them resources that a business owns. The key word here for assets that I want you to remember is it's got to be something that the business owns. So before we can start a business, we have to have some cash to operate with. So cash is one of the most important assets that we can have. It's the first asset that we list as an example of an asset, and it's something that we have to have in order to operate a business. Another example of an asset is something that we call accounts receivable. Accounts receivable is money that we expect to collect from customers in the future. What we're going to be doing is we're going to be operating a company that we call a sole proprietorship. Sole proprietorship is a one-owner business, and we're going to be operating a company that provides services to its customers. So when we provide a service to the customer, we have the right to ask the customer to pay us cash right then once we perform that service, or we can ask them to pay us later. And we're expecting that we're going to be collecting cash in the future from the accounts receivable. So accounts receivable is money that we expect to collect in the future. Notice its title here says receivable. We're expecting to receive cash in the future. So accounts receivable is going to be an example of an asset. You need to be able to classify your information. So when we start to look at business transactions, we'll read the transaction to see if there are any assets involved. If they are, we're going to classify them under the assets section on our accounting equation. So today, what I want you to concentrate on is learning the definitions of what an asset is and an example of an asset. Be able to give me examples of assets. Another term that we use to describe an asset is something that we call prepaid expenses. And prepaid expenses are the cost of doing business that have been paid before we've actually used those asset accounts. An example of a prepaid expense is prepaid rent. If we are a landlord and we rent buildings to customers, or if we rent buildings to our renters, we might ask them to pay us in advance. If we ask them to pay us in advance for the rent, it's called prepaid rent because it's really an expense to us, but we just haven't used that expense yet. So let me say to you here that a prepaid expense is a cost that's been paid for before they have been used. The key here is it's been paid before it has been used. And so if it's something that we've paid for ahead of time and we haven't used it, it's called an asset until it becomes used. Once it becomes used, then we'll place it in another category, which is called expenses. But if it has the word prepaid on it, it's an example of an asset because it's a cost that have been paid for before they have been used. So in our example for prepaid rent, let's get on the right side of the fence for this. If we are a renter and we're paying for 2 months rent in advance, we're going to call it prepaid rent. And in the first month, if we have used the first month of that rent, or if we have gone through a month of rent, then it will become an expense, which is going to go somewhere else. I know that this kind of got into a complicated topic here. So what I want you to know for today is that if it's a prepaid expense, it's an expense that's been paid for before that asset has been used. Maybe a better example of a prepaid expense is supplies. What you would have to do is you would have to purchase supplies and bring them back to your business. And once you purchase the supplies, you would not have used them, but you most likely would have paid for those supplies when you purchased them, and therefore they become examples of prepaid expenses. So supplies is an example of a prepaid expense because when you buy the supplies, you have not used it yet. It's still asset to you. Once you begin to use the supplies, it will become expenses. So we can have prepaid expenses that we purchased ahead of time, and they are assets to us. But over time, we will be using these assets and they will become expense over time. In accounting, what you're going to learn is that we measure economic data for time periods. So for an example, we might decide that we're going to measure the data on a monthly basis. So we're going to start from the beginning of the month and we're going to go all the way to the end of the month. At the end of the month, we're going to measure what's happened during all through that month, or during that month, all through the month, we're going to measure what's happened with the economic data. So if we have bought supplies and we've taken them back to the office and we haven't used them, what we have in supplies is an asset account. It is considered to be a prepaid expense. But at the end of the month, we're probably going to take an inventory of those supplies to determine how much of the supplies that we've used. So we may have bought $100 worth of supplies at the beginning of the month, but by the end of the month, we will have used some of those supplies. So we're going to take an inventory of the supplies to see what we have left. What we have left is asset. What we have used is expense. Right now, examples of prepaid expenses are prepaid rent, which is rent that your company would have paid in advance to a landlord. And then a company who has purchased supplies is an asset to that company until the supplies become used, and then we will make it an expense. But when it's purchased or paid for, we are going to record it as a prepaid type of expense. Another example of a prepaid type of expense is what we call prepaid insurance. And prepaid insurance is an asset to us because we have to buy insurance before we have the right to use that insurance. So once we buy the insurance, we put it in an asset account. At the end of the month, we might determine how much of that insurance has expired during that period of time, and then we will put it into what we call an expense. But before the asset has been used, it will be an asset to the company. So anytime we buy supplies, we're going to put them in the asset account first. Supplies is an example of a prepaid expense, and all prepaid accounts are assets. So if you see something with the word prepaid in front of it, you might see something like prepaid taxes. That signals to you that you've already paid for those taxes ahead of time, and they are assets to you until they become used. So prepaid expenses are costs that have been paid for before they have been used. The key word there is it's been paid for before they have been used. These are examples of prepaid expenses, and all prepaid expenses go under the category of an asset because prepaid expenses are something of value that the business owns, and they are assets to the company. Another common example of an asset might be the land that you have bought to put your building on. Land is an example of an asset because it's something that your company owns. Buildings is another example of an asset. Equipment is also another example of an asset. All of these items right here are examples of assets. It's important when we're learning accounting to know what the definition of an asset is and some examples of assets. So again, assets are things of value that a company owns. The key word there is they own it. They own the right to use these resources, which are assets. Liabilities are amounts that are owed by the company. So liabilities is also a part of the accounting equation, just like assets are a part of the accounting equation. The liabilities is over on the right side of the accounting equation, whereas the assets are over on the left side of the accounting equation. What you need to be familiar with is the definition of a liability. Liabilities, the definition that I could come up with that was the simplest that I could think of, are amounts that are owed by the company. The key word here is they are owed by the company. So some examples of liabilities are accounts payable or notes payable. You might notice that both of these terms here have the word payable associated with it. All payables are liabilities, just like all prepaid accounts are assets, and all receivables will be assets. So liabilities are amounts that are owed by the company. That's the definition. And an example of a liability that you're going to be working with in this chapter is accounts payable. You might work with some notes payable too. The only difference between an accounts payable and notes payable is that a notes payable is set up as a promissory note. There's a written document with the notes payable that says that you owe somebody some money and you're going to pay them back in the future on a specific date. And usually a notes payable has some type of interest associated with it. To keep things simple today, we're not going to talk about the interest that's associated with it. I just want you to be familiar with the term notes payable, and notes payable is a liability. You need to know that all payables are liabilities. So if you come across a name such as account payable, you will know it's a liability, or notes payable is a liability. It meets the definition, in other words, of an amount that is owed by the company to someone else. Usually we owe liabilities to our creditors. So liabilities are also sometimes what we refer to as creditor equity within the company. The creditors are the owners of your company if you don't pay your liabilities. But hopefully, if we have created a liability, we are creating that liability in good faith, and we are planning to pay our debts to a creditor in the future. Accounts payable is a account that is set up for us so that we can have credit with maybe a supplier. So if we wanted to buy supplies from a particular vendor, we may have an account set up with them. And if we purchase supplies from that vendor, our accounts payable will increase. Usually accounts payable does not have any interest associated with it normally. Accounts payable is just an agreement that you set up with another company to be able to buy things on credit. So a liability is an amount that is owed by the company, or they are amounts owed by the company. The key word here is owed. The third part of the accounting equation is what we refer to as owner's equity. In this chapter, we're going to be talking about a sole proprietorship form of business, which means it's going to be a one-owner business. It's the simplest business to form, and it's the simplest business to operate with. We're going to have one person who's going to own the business, and the owner's equity is the amount of owner's worth in that business. Another way to look at owner's equity is that it's the amount that is left over when the liabilities have been deducted from the total assets. And so when we are going to be looking at the accounting equation, our owner's equity is the part that's going to be left over after we have subtracted out our liabilities from our assets. That's going to give us the amount of the owner's worth. The owner's equity is the amount of the owner's worth in the business. There are going to be 4 items that will affect owner's equity, and it's very important that you learn these items. I can't stress to you enough how important it is to learn the definitions of the accounting equation elements and examples of those definitions, as well as the things that affect owner's equity. There are going to be 4 items that will affect owner's equity. And one of those items is what we call an owner's investment. If we are operating a sole proprietorship, the owner will have to make an investment in the business with cash or non-cash types of assets. What that means basically is we can't start a business without some cash. So usually what an owner does is they take money out of their personal account and put it into a business account for the business to operate with. So when the owner gives the business cash or any other assets, they are called investments by the owners. And the owner's investments will add to the owner's equity. They're going to increase the amount of the owner's worth. And so when we get to analyze transactions through the accounting equation, one of the first transactions we're going to look at is starting a sole proprietorship with an owner investment. We'll read that transaction carefully, and we will place the amount that the owner has invested in cash into their owner's equity account. Another name for an owner's investment or owner's equity can be capital. So you might see the term capital. If you do, it should reveal to you that you are talking about owner's equity. And owner's equity is the amount of the owner's worth in the business. Revenue is also something that will add to our owner's equity. Revenue's definition is an amount earned from customers while operating the business. It's an amount that we've earned for conducting a service in the business, or maybe we are selling a product. The sales is the amount that we would earn from our customers while we're operating the business. Revenue is an amount that's earned from customers while we're operating the business. If it's a service type of business, we will perform the service. Once the service is performed, we can call it revenue. Once we can call it revenue, we have the right to collect either cash or accounts receivable from that revenue transaction. And revenue will add to the worth of the owner. The more revenue that an owner has, the higher the owner's worth is in the business. So revenue will increase the owner's equity in the business. Revenue will increase the amount of the owner's worth. Sometimes revenue is referred to as fees earned. So if you see any title, it might say professional fees earned. It might just say fees earned. Sometimes I have seen it just stated as fees. These are examples of revenue. It depends on what type of business you are running as to what type or what the name of the revenue will be. If we are a business and we're providing a service, we could name our revenue professional services earned. That would be a revenue account. Or we could call it professional services. That would be a type of revenue. If we are charging a fee to a customer for work that we're providing in our business, it will be a type of revenue. If we are a merchandising form of business, we would be selling something to our customers. Sales is a type of revenue. We will be talking about merchandising businesses toward the end of the semester. But right now, we're going to focus on a sole proprietorship form of business. And the first type of business that we're going to be looking at is a service type of business. But your revenue account could be called fees earned. It could be called services. It could be called sales, depending on the type of business that you are operating. But it still has to meet the definition of revenue in order for it to be revenue, which is an amount that's earned or charged to customers while we're operating the business. Expenses are cost of doing business. An expense is going to be an asset used while we are producing revenue. Expenses will decrease the amount of the owner's worth. So the more expenses that an owner has, the less he's worth in the company, because expenses are cost of doing business. So you might remember when we talked about prepaid rent. When we buy rent in advance, or when we pay for rent in advance, let's say we pay for 2 months rent, and the rent is $100 a month. So the total prepaid rent would be $200. Let's say we pay for that rent at the beginning of August. At the end of August, we would have used 1 month's rent. That 1 month rent that was prepaid to start with will become an expense. So assets, prepaid accounts that are used while producing revenue will become expenses once they are used. So if we have supplies and we use up some of our supplies, by the end of the month, it will become an expense to us. Expenses are cost of doing business. Salary expense, rent expense, supplies expense, insurance expense. These are a few examples of expenses. Notice the examples of expenses usually has the title expense on them, so you'll know that it's an expense. But you have to know that expenses affect owner's equity, and owner's equity will be decreased. The owner's worth will be decreased the more expenses that you have within a business will cause the owner's equity to go down, or it'll cause it to decrease. Another example of something that will decrease owner's equity is what we call the owner's withdrawals. If the owner has a withdrawal, what the owner is doing is they're taking cash out of the business to use for personal purposes. The withdrawals are going to decrease the owner's worth. They decrease the owner's equity, in other words. So if the owner comes to you as the accountant and says, I need some money, I need to make a car payment for my personal car. And so this would be a type of personal expense. We can't record personal expenses in the business account. The owner has to take the money completely out of the business. And to do that, we would create an owner's withdrawal account that is sometimes called drawing in this course. But the owner's withdrawals are where the owner is taking money completely out of the business so that they can pay for some type of personal expense. The owner's personal expenses cannot be paid with the business's cash. The owner has to withdraw the cash out of the business, and then they have the legal right to use that cash to pay personal expenses. So the owner's withdrawals when the owner takes cash out of the business to use for personal purposes. What we're going to be doing in this chapter is we're going to be recording transactions through the accounting equation. This is one form of the accounting equation. Notice that assets are on the left side of the equals mark. Our liabilities and our owner's equity are on the right side of the equals mark. Liabilities sometimes can be referred to as creditor equity. Creditor equity plus owner's equity is the total equity of the company. the total equity is equal to the total assets in the accounting equation. In other words, the left side of the accounting equation has to be equal to the right side of the accounting equation when we have analyzed a business transaction. We will be recording business transactions and analyzing transactions through the accounting equation in this first chapter. We're going to be recording the business transactions through the accounting equation on a daily basis. So we are going to be in the process of collecting financial information. We're going to be recording it in the accounting equation first, and this will help us to organize all the economic information for a period of time where it will eventually be reported in the form of financial statements at the end of the accounting period. At the end of the accounting period for a month, or at the end of the accounting period for a quarter, or at the end of the accounting period for a year, depending on when your company's management decides they will report the financial information. Again, in this class, we will be preparing financial statements for a proprietorship form of business. A proprietorship form of business is a one-owner business. When we analyze transactions through the accounting equation, we're going to be recording increases and decreases in part of the equation. And we'll record these increases and decreases in parts depending on when the transaction is made, and we will be recording those transactions on a daily basis so that at the end of the accounting period, we can measure what has happened for a period of time. When we analyze business transactions, there are some rules that we have to follow. Every transaction has to have at least 2 parts associated with it. And every business transaction, once it is analyzed through the accounting equation, the left side of the accounting equation, which is your asset side, will have to equal the right side of the equation, which is your liabilities plus your owner's equity. Now, I know that I've thrown a lot of information at you for the first video, but it's important to me that you learn these definitions that I have given to you here. Learn what the definition of an asset is. Learn what examples of assets are. Learn what the definition of liabilities are. Learn what examples of liabilities are. Learn what the definition of owner's equity is. Learn the things that affect the owner's equity. And I will take you through analyzing transactions through the accounting equation the next time that we meet. But you need to be familiar with the parts of the accounting equation, which are assets, liabilities, and owner's equity. So you need to know the definitions of these items and the things that can affect the owner's equity, or the assets and the liabilities and the owner's equity. You have to know what goes into the accounting equation before we can analyze business transactions. What we're going to do for the rest of the chapter is analyze business transactions. We're going to organize our information from these transactions into the accounting equation. You're just putting it in the different categories. So the first chapter is all about getting our accounting information organized so that we can report it to the users of our financial information. I know I've covered a lot today. I want to stop here. I will be posting this video under Throwers Videos for Chapter 1. I will also post the notes to this chapter as we go, and it'll probably be in Throwers Videos too. So I'm going to leave the session for this time, and I will create another video for you later on where we're actually analyzing transactions through the accounting equation. But until I do that, I want you to make sure that you read Chapter 1 carefully. Look at the terms and the definitions of Chapter 1. They are very important for you to know how to do. And something else that I want to show to you before I leave you today is where your reader is for your textbook. It is located in Blackboard. So I'm going to stop sharing this screen for just a second. And I'm going to go back to Blackboard, and let me see if I can pull up for you the screen reader. It might take me just a minute to do that. So hold on just a minute. I'm going to go into a Blackboard course, and I'm going to show you where you can find your reader. So hold on with me just a minute as I get this put back up on the screen, if you don't mind. Okay, you should be able to see right now an Accounting 120 course. Since this is a video for ACC 120, I'm going to show you where you can find your assignments. Now, I'm recording this session for you, but I'll also be sharing it with another class section. So if your section is not D6C, you can still find the videos in the same place. You just have to be able to log into Blackboard. Once you're in Blackboard, click on Assignments. And then what you will see on your screen is your chapter assignments. If you'll scroll on down to the bottom of the screen, you can see down here there's a MindTap reader for Warren, Reeve, and Ducock Accounting, which is your textbook. If you'll just click on that, it'll take you directly into your textbook. You might also notice while I'm here that there are some practice problems that I have available for you to work. If you just want to work some things that are non-graded types of problems, I've got plenty of those there for you by chapter. I've got study guides available for you by chapter too, or by chapter also, I guess I should say. So just click on any of these if you want to look at them to help you to study. I've got lots of things built into the course that should help you for your course. But to get to the reader version or your textbook, your e-textbook, all you have to do is click on this link. When you click on the link, you'll see that Cengage is loading the content. And I'm just going to click on that to see if I can get it to come up to where you can see a chapter here. Yours may not look so much like this. I don't know where they put us to right here, so I'm going to go back for just a minute. I'm going to stop sharing the screen for just a second. I'm going to go back to where I was before, and I'm going to share the screen with you again. So be patient with me as I try to get back to the original screen. And I'm not there yet, so again, if you'll just be patient with me. Well, finally, here we go. And so it's really more simple than what I just showed you there. So I'm going to share my screen with you again. I'm going to go back to Blackboard. You should be able to see Blackboard. Just click on assignments. And once you click on assignments, scroll down and click on this MindTap Reader. It should go directly to the textbook, and you can open it up chapter 1 and be able to see that there. For some reason or another, since we're live recording this, it threw me into something else, but this is where you would click on it to get to your MindTap Reader. If you have trouble with any of this, do not hesitate to send me an email. I will be glad to answer any questions that you have for me. I'll answer you through email, or we can actually meet on Blackboard Ultra, and that would be a way that I could see you and you could see me if you want to actually physically talk to me. We just have to set up a time when you want to do that, and I can meet with you if you have any questions at all about anything at all, class. So this time I'm really going to stop this video because you probably had enough by now, and then I'll share another video with you at a later time. Bye-bye.